Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Hello there. Well, the kids are back at school. It's 98 degrees in Chicago, and I'm not wearing sunglasses. And if you didn't get that, please go watch the Blues Brothers. But anyway, let's get to the pod. We're sitting down today with Bill Gebhardt of 10dynamics. So named because of the 10 core trading signals Bill systematized to build out his multi-time frame model. We go from Bill's days in the Chicago option pits, to his energy trading days, to his work as an allocator of sorts, hiring traders into a Deutsche Bank prop trading arm. In between all that, we touch on quantamental trading, prop versus multi-strat, discretionary versus systematic, and one of my favorite lines of late, being allergic to optimization. Send it. This episode is brought to you by RCM's Managed Futures Group, which helps match up investors like you with unique managers like Bill and 10dynamics. Go to rcmalts.com, rcmalts.com, and call our group to see how we can help build a portfolio of unique managers to meet your unique risk and reward parameters. All right, everyone. We're here with Bill Gebhardt of 10dynamics. How are you, Bill?
I'm great. How are you?
I'm great. Beautiful, sunny, 60-degree day here in Chicago in August, which is super rare. I was seeing it pop up at coldest on record, I think.
I was going to say, I lived in Chicago for a bit, and that sounds awfully cold for August. I remember sweating in bars in August.
That's the way you're doing it. If you're going to be sweating, do it in a bar.
Yeah, exactly.
How's London this time of year? Lovely? Cold?
Yeah, London's pretty nice. We're cooler than you guys. We're probably 69, 70. Well, actually, not you right now. You're colder than we are, but typically we don't get really hot like you do in Chicago. But it's
how long
nice.
You been in London?
23 years now.
Wow,
so it's been a while. Yeah.
All right.
Yeah.
And before that?
Well, originally from Colorado, but then I moved around a lot for jobs. I was in Chicago, as I said, for a while. I worked on the CBOE for a bit, way back in the early 90s. So got my not floor trading, I was a clerk, but got the experience of being on the floor, which is, I think, one of the coolest examples of complete chaos resulting in order that you'll ever see.
Exactly.
And it's a shame that kind of the open outcry has gone away with technology, but yeah, that was interesting. But yeah, I moved around a bit and ended up at one point down in Houston working for an energy company, and they did a joint venture that brought me to London. So I've been here since then. I came on a 2-year expat deal and just never left.
Never left. And my listeners know I'm not going to let you say Colorado without talking skiing for a minute. So where were you from in Colorado?
I grew up in Fort Collins. I went to school in Boulder at CU.
Awesome.
Yeah.
So you're a Dion fan? You liking what's happening with primetime?
Yeah, I think it's pretty interesting. I mean, my this is how old I am. I was in the McCartney era, right? So my first year at CU, I think they went 1 and whatever the number of games was, they're 1-10. And then McCartney came in that next year, and by the time I left, they'd won the national championship. So it was a pretty good run. But yeah, it's been kind of up and down since then. So good.
Love it. What were your favorite ski areas?
Well, my brother lives in Steamboat, which I like quite a bit. I mean, being in Boulder was just really easy to get up to sort of Winter Park and Mary Jane. And back in the day, I was obsessed with mogul skiing. So Mary Jane was my go-to.
That's a fun one. I love it. So not here to talk about skiing, unfortunately, but 10dynamics, you guys are doing some cool stuff in trend. 10 different signals, 15 different time frames. So I want to dig into that, but let's first, you've got a bit of an interesting background too. So give us a little bit about how you got to 10dynamics, how you founded the firm, and sort of the financial background you have.
Yeah, it's a little bit of a long story since I've been around for a while, but I worked for a bit. As I mentioned, I was on the floor of the CBOE for a while, and then I went off and I worked for Chase back when Chase was separate. Worked in their mortgage bank in Florida and did some finance stuff, and then ended up getting a PhD in finance from Cornell. So I went back to school for a few years and
you didn't kill yourself. You didn't jump off the Cornell bridge. Yeah.
No, I did not. I did not. But it's yeah, they work you pretty hard there. I'd say it's a great school though. I love Cornell. It was really really good. I finished my PhD in 2000, and then one of my actual former professors from Colorado worked at Koch Industries and convinced me to get into the energy trading business. And so yes, I moved to Houston and worked. This is kind of even far back in time. So this is the Enron days, and my
Nice.
first job was on the weather derivatives desk. So that was a very quanty sort of derivatives product at the time, and that's where I got my first exposure to energy trading um,
Was it
and kind
hard?
of.
Was Enron at the time like just the elephant in the room? Was it hard to actually get trades off and do things with them being such a
No,
big player, or they were?
I they were a great source of liquidity. I mean,
Mm,
I think they were obviously super successful in what they did, but they were really important for the liquidity in the market everywhere they went. So, when I joined, within a year, I ended up coming to London because Coke sold their energy trading business and put it into a JV with Entergy. And so Entergy Coke was this joint venture, and Entergy had an office in London. And so when I came over, there were already, I think, 21 US energy companies active in Europe at the time.
mm.
And that was led by Enron, right? They came in, they sort of structured the market, they got liquidity. I mean, there were existing markets here, but they did a lot to bring liquidity and change contracts and bring a help the market develop. And that's why all the American energy companies were here. And then Enron went under, and within, I think it was 2 years, there were only two left. And it was us, Entergy Coke, and Sempra. So out of the 21, there were only a few survivors, and that was just because both of us had higher credit ratings. So everyone else was kind of triple B plus, and they couldn't survive the implosion.
Mm.
Um,
Sorry,
and
I derailed you, but Enron,
yeah,
Enron
yeah,
has lots of questions, right?
yeah, yeah, exactly. And then from there, we got bought by Merrill Lynch, and worked at Merrill in the energy business, and was head of, at the time I was head of Energy Coke's fundamental trading or fundamental analytics group. So we had a very close, one of the things that we did that kind of Enron did too, was we had a very close pairing with a fundamental analyst with prop traders. And it was a really good model at the time. And at the time, that's really where I started my trading career, was developing fundamentals and trading off the back of that. So kind of bottom up fundamental modeling. And in 2000, it was a really great time to be doing that because there's a lot of information that wasn't available at the time. So you could actually find information to feed into models that other people didn't have. And a lot of the models were pretty new. So you could do a better job of forecasting demand and supply for just on the pure modeling side. So, we had an incredible run, and I think at
And
the
some of those
time.
inputs are like storage numbers that people didn't know and things of
Well,
that
things
nature.
like, I mean, we had, in Europe, you had things like hydro production, and
Mm.
the governments would produce the hydro numbers, but they almost, at the time, there wasn't this sense of like everything should be open. So even though they would put it on the web, they wouldn't make it easy to find it, and they would only allow you to download it once every so many, like 24 hours. They had all these restrictions on getting the data, and so you could find data that was, just because the market hadn't developed enough, that people weren't using or hadn't really thought of, with particularly in the power market, the more granular you get, the more accurate you get. And so initially you just say, well, let's look at temperatures and try to forecast demand. And then you got to figure out, okay, well, yeah, there's a lot of different kinds of power production, but you've got, at the time, there was hydro production, run of river, which is basically driven by precipitation. And so there were lots and lots of things that you could add to your model to make it more accurate. And that was a super successful approach. And it was an approach that led to, eventually I ended up at Deutsche Bank in 2007, and was ended up heading the European energy trading group there. And so trading power and gas and emissions credits came along at the time. And it was really that bottom up fundamental prop trading approach. And one of the things that was clear, though, is that more and more people were doing the same things and getting access to the same data. And so you were losing your edge, if you will, or you losing a bit of diversity of opinions. You had lots of people coming to the same result. And the result of that was it got harder. So, I think if you look at performance over my career for fundamental trading, it's been on a steady decline. in the commodity space. I think
Hmm.
it's still, some people are still making money there, but it's gotten way harder than it was, and you have to invest a lot more to get there to do it than we did at the time. So
Isn't that
it was,
always the story? No, nobody ever comes on the podcast and it's like, it's way easier now than it was
yeah,
back then. It's always
yeah.
the case of like, oh, it was all this info was just right there. You could grab it, make a
Well,
lot of
and
money.
yeah, for sure. It depends too on what you're, if you're trying to, particularly if you're going after mispricings, right? If you're
Mm.
going after mispricings, then, regardless of whether you think markets are truly efficient or not, they're efficient enough that if enough people are doing the same thing, it's not gonna work forever, right? So it's harder to find those places where you get mispricings um, and so yeah, so from there, I ran the desk for I guess about 6 years, and um,
At Deutsche for 6 years
yeah, Deutsche.
and started in '07. Didn't the stock go down 90% probably right after you
It,
started?
it it did. It did. I had one of my best years ever in 2008. As a desk, we used to joke we made more money than Deutsche Bank because the bank as a whole lost money like everybody did
I
in
bet.
2008, and we had a great year. So
Do you
we
get
were
netted out, right? Like a lot of these
yeah.
people leave because their bonus is
I'll
like, oh, sorry, you did great, but the
I'll
bank
tell
lost all this
you,
money.
people make a big deal about being uncorrelated, or particularly about being a hedge. Like let's say you run a hedge business. That sounds great in theory, but the reality is when the hedges pay off, nobody has any money or nobody has
Yeah.
any capital. So bonuses don't go along with being the great
Mm.
performer when you're a hedge. And it really is, I've seen it happen in my career a couple of times where you have an outperformance when everybody else is not performing. And unless you have some contractual guarantee with somebody who's got deep pockets, you're probably not going to have a great year yourself, right? So it's tough. It's tough being in
Yeah.
that spot. So
That's super interesting, right? It's like misaligned incentives because it'll create this thing within the banks where everyone wants to be on the correlated trade, so they
yeah.
get paid, right?
Completely. You're
Mm.
way better. The people who were on riding the tide, they made way more money than the people who were there trying to, be the ones who, performed in bad times and I'm sure there's lots of people with similar stories depending on what they were doing, where they had their one great year and yeah, it didn't work out so
Yeah, a
great for
lot of the
them. So
traders that become good CTAs, good hedge fund managers are right. That was the trigger that got them out of wherever they were and said, well,
yeah,
this is crap. I
yeah,
made all this money. I didn't get paid. I might as well go on myself.
exactly. Exactly. Yeah, that was pretty interesting time too to see just all the things that can go wrong. I think when you in the business for a while, you start to see, how easy it is to be overconfident. One of the things we can talk about it too, like it was sort of the foundation of one of my philosophical principles is I am allergic to optimization.
Mm.
That's my saying, allergic to optimization in all of its forms. So we don't really optimize our system at all. That's kind of one of the core things that we don't have any parameters that we optimize. Um, and I think that comes from seeing how easy it is. Even really smart people can fool themselves through optimization, thinking that they know a lot more than they do. And then, in the case of 2008, correlations all go to one when supposedly they don't. Or, you have things that never dislocate and suddenly they're 400 basis points apart when they're usually five, things like that. And, if you optimize too much and you can really get yourself in trouble. And we saw that, a couple times in my career. We're sort of try as
Yeah.
hard as we can not to do that.
I call that statistical correlation and fundamental correlation, right? Like,
Yeah,
cool, all this is statistically non-correlated. It looks great in the back test, but what are they actually doing? And is
yeah,
what they're doing going to become correlated in a crisis? So you
yeah.
gotta have both pieces, right?
And I think that's one of the big things you learn being in commodities that you don't get from financial markets. Financial markets people that I meet, they are way more confident in correlations and covariance matrices and things like that. And I get why, because they are more stable. We're in commodities, if you start doing bottom up fundamental and modeling, you have switching points. You have
Mm.
things where the correlation can be close to 100%, and then you switch a substitution point, and suddenly the correlation is negative. So you can't, that's why you don't see people in commodities doing the same types of things you see in like equity space and whatever with really relying heavily on correlations because they're highly volatile.
So you survived the first downdraft in Deutsche,
Yep. Yep.
but then the second downdraft, you said
Well,
that's
no, I
enough.
think I think it was, you had the crisis, right? And then everyone started to figure out what was going to happen. And just like I think the same thing happened, around the Great Depression, it took like 4 or 5 years before the SEC and the CFTC and all those rules got put into place that change everything. So you just had Dodd-Frank and some of the other changes in Europe. You had limits on bonuses that are based on salaries. And so you had a lot of changes. And then the big thing was accounting. You had changes for how derivatives are accounted for in banks, which really increased the balance sheet charge that you got for trading. And energy was still a very prop business, even inside a bank. We didn't have lots of customer flow. The one again, big difference for commodities inside a bank is typically you're dealing with people who know more about the commodity than you do. If you're trading oil, you're trading against Vitol and other oil traders who are as smart as you are. Where if you're selling a financial product to a corporate that's hedging their price risk for some input, they probably don't know as much about the market as you do, so that you're unlikely to be taken advantage of. Where in the energy space, if you're offering solutions to clients, a lot of times you could be on the wrong end of that. So it was really a prop business. And as you know, prop trading and banks sort of went away for all the reasons, everybody's aware of. And so then I left in 2012 and started with some partners. So the management team at the commodity business at Deutsche, our head of commodities, started Trailstone, and myself and the head of oil and the head of metals, we all left Deutsche to join Trailstone, and so started a kind of new commodity energy merchant in 2012, and I was responsible for the European business. And it was the same basic approach, bottom up fundamental trading, but we had an idea, at least in Europe. Our strategy was around assets, because assets were super cheap, power assets at the time. So we wanted to, looking to buy power assets and then build a fundamental kind of trading
Does that
shop
mean
around
like
that.
owning the actual power plant?
Yeah, owning the actual power plant. Yeah. And it's a really good model when you can do it at the right time of the cycle. And that's one of again, I talk a lot about commodities and energy because I think it's such a great market. But one of the reasons why they're such good markets to trade is because of the huge investment cycle. So you go from oversupply to undersupply repeatedly. You can look back over the last, as long as you want to look, and you just see these cycles of excess supply and then price tightness. And that is driven by the investment cycle is so long. If you want to build a new power plant because prices are too high, it takes you a while to do it. So you get these nice cycles in energy in particular that I think are kind of what leads to, as we'll talk about in a bit, kind of the money that you can make in terms of trend following. It's the same sort of cycle that you're catching, really.
And then was that tough? You're competing with like Glencore and those kind of groups of like big,
Yeah.
huge.
Yeah, we were a bit more niche because we were just doing power and gas at the time. So and we did oil as well. We owned an oil refinery in the US for a bit. And so yeah, we were competing with kind of the big names in that space. Had our own one of the other things they did, we had a very renewable energy focus, which they still have at Trailstone. That's a big part of their business. They've just been acquired recently, but so we were pretty, I think we've successful over the time building that business. We didn't end up buying any assets though, and that eventually led to kind of changing the business at Trailstone. And that led to me leaving and starting 10dynamics.
Trailstone, you guys were launching a few different managers and things of that nature as well.
Well, Trailstone was, we had a big prop trading team, and one of the things that over my career, I've seen many attempts at systematic trading and quantitative trading, usually driven by quants. So it's, tends to be more the technical, and I don't mean technical analysis, I mean more technical in terms of mathematical type of approach to that business, and it was never successful. And over, many years and many different attempts, and for various reasons, and then we ended up hiring a team of systematic traders that had been successful over quite a long period of time, and they had a great track record and convinced us they could do it. And so we hired those guys into Trailstone, and they were successful. But we realized
a pod shop before it was a thing.
Yeah, I mean, we didn't really want to spin them out because we didn't know we'd need to. We didn't realize how broadly applicable their strategy was, I think, at the time, and how much more capacity they could manage than we could ever fund. Because we were an energy trading company. We didn't want to be a systematic hedge fund, right? So we realized, these guys, would probably be better for them if we help incubate them and spin them out. So we spin them out into their own business, but It was really influential on me because, for the first time seeing what a good systematic team does and kind of how they approach it, um, and what I learned from that, was that some of the things that because I had a PhD in finance over my career, both trading and managing traders, I built up a lot of tools that I was using for my own trading to help, mostly around timing for fundamental type trading. Because the problem you have with fundamental trading is, and this is the sort of the bane of fundamental traders, well, we're in too early, which
Mm.
is AKA we got stopped out, right?
Yeah,
So,
right. Right.
and that is a thing because because at the end of the day, most fundamental trading is counter trend. So if a market's low, you think it's cheap, it goes lower, you think it's even cheaper. So you tend to like it the more it goes against you. And so, timing becomes, if you're not paying attention to timing signals, you end up, getting stopped out or having big drawdowns or whatever. So I was using timing signals to help alongside the fundamentals. But then what I saw with our systematic group was that, that the competition on the fundamental side had gotten so tight that actually the systematic systems were outperforming, on an average year, were outperforming most people on the fundamental side.
Mm.
Now, you'd have a great year of fundamental trading where you have some shift in fundamentals, and you'd have an amazing year where the systematics wouldn't be able to keep up necessarily. But by and large, it was a it was as good or potentially better in a lot of different circumstances than fundamentals. Um, and so, I'd gotten to the point with this tools that I was using at the time that I thought all I needed was the tools. I didn't really need the fundamental inputs anymore. But I needed to, make them more systematic because they were, it's tough to do everything by hand. You can only watch one or two markets at a time. And to me, the idea of being able to be diversified across a lot of different markets is really valuable. And that was kind of the seed in my mind, I guess, to, well, maybe I should take the tools that I've got and see if I can put them into a system and apply them to a broader range of markets. So yeah, that
Awesome.
was
And then that became 10
that
dynamics
became
and
that became 10
your main
dynamics. Yeah.
model.
Yeah.
So
And so
let's dig
we're
in. 10 dynamics is because
Yeah, it was because there's 10 basic signals that I've developed over time, and these are kind of old and tried and true. I mean, the first one of these signals I actually wrote in 1992. So it's
mm,
been around for a while, and my approach has been maybe different than what a lot of systematic people do. And a lot of the approach that I've seen from systematic is come up with 1,000 ideas, test them all, see which ones work, keep the ones that work, and assume they're going to keep working and throw out the rest, right?
right.
Without any real connection to the market itself. And because I had spent my career looking at the market and working with traders and that kind of stuff, I wanted a system that traded like I would trade. So as I was developing the signals, if I would get a signal that I would say to buy, even if it made money, I wouldn't want that signal because it's a trade I wouldn't take. So I wanted to strip out every signal that the system would produce that I would not believe in and not take.
Mm,
Hand on heart. So I'd like try to do put your hand over the chart and say, would I take this or not, and try to
yeah.
ignore what it was doing.
Which is sort of the opposite of classic trend following, which is like, I have no idea why this market's breaking out. I don't
Yep.
care. I'm just going to get in line.
Exactly, exactly. So what I wanted was a system that modeled my decision making as closely as possible. So that's really what we built, was something and now I would say, I used to think, as I was developing the tools over the years, that there were times where the tools would be kind of like, maybe you should buy here, and I'd be, nah, that doesn't look right. And occasionally my intuition would be right. But probably I would say it's been, God, at least 6 years since I felt like that. I feel like now the system is always right. If I'm trying to outguess the system, it's a mistake.
Mm,
I feel like the system is a better version of me somehow. It's taking all the trades I would take without any of the emotion or conflicting signals or other things
right.
that can
Which
influence
is
you
the
on a,
point of systematic in the first place, right?
yeah.
Take all that away.
Yeah. So that's really what, we try to say, look, what we're trying to do is we're trying to model a prop trader is what we're effectively trying to do. Now it's true we're using prices to do that, and we're using, things that aren't what we necessarily would like a fundamental trader would use, but it's that same concept. So, even how we do risk management, we can talk a bit about all that stuff, but there's things that we do specifically that are modeled on how I think a good prop trading desk works and how you manage risk in traders and that sort of thing. So,
So
um,
do you consider yourself a trend model or no?
yes, because we follow the trend. for sure. So we're definitely trend following. But we don't know, we can, talk a little bit about the signals.
Which
We
basically,
don't
as a
do,
prop trader would follow a trend, not as a
yeah, yeah, kind
systematic
of,
would follow a trend.
I guess in just yeah, I guess the thought process around it, exactly. So I used to have this way of looking at a market and saying, oh, or even looking back and saying, well, here's a reasonable place where you should have gotten in. What signals would you get to get in there? That you're not going to pick the bottom, you're not going to pick the top, you're going to pick some reasonable place to get in. Well, what would make you get in there? And so kind of thinking through how the signal should work as a whole to try to identify those areas. And I started with a couple of philosophical things. One is my PhD, I was doing behavioral finance at the time. So
Hmm.
I was sort of a big believer. And one of the early, this was in the sort of, early 90s, right? And that was just at the beginning of the behavioral finance movement. So you were still a heretic in the eyes of anybody from Chicago if you start talking about behavioral finance.
Yeah.
Um, but yeah, so I did some research in that and really started to believe um, that markets at the end of the day are just driven by human psychology, and there's kind of underlying factors that push it one way or the other, and that I think unlike efficient markets where it's like the market moves exactly where it's supposed to go, and then something happens and it moves exactly where it's supposed to go. And I think it's the opposite. I think it's like, we use waves as this analogy all the time. I think I always view it like a pond. And when a pebble drops in a pond, that's like news. That's news hitting the market is like a pebble dropping in the pond. And then there's this wave that propagates, and I think that's the way markets really work, is this sort of propagating psychology that repeats itself. And so that's kind of had that in mind when we were, when I was developing the signals over the years. And the other thing that I got experience with in the 90s, um, that was when sort of Mandelbrot and fractal mathematics was kind of a hot topic, right?
Yeah.
And I get interested in that. And I also had in my PhD, I had a class from a kind of famous professor who's a big market pricing guy, and he did this thing that I think all efficient market guys do. They put up a unlabeled chart of a stock or whatever, or quote unquote stock, and they say, can you guys guess what stock this is? And go around the room, and everybody has their guess. So it's whatever, Microsoft, whatever. Oh no, this is a random walk.
Hmm.
See how you guys were all fooled? A random walk looks exactly like stock
Yeah.
prices. But then what I did is I went and I generated 100 random walk paths. And what I realized is that was cherry picked. If you generate 100 random walks, they don't look
Uh,
anything like stock prices.
yeah.
90% of them look nothing like stock prices, right? So it was okay. Yeah, statistically, it's great for kind of mathematical finance from a statistical point of view, but it didn't really look to me the way markets behaved. And then taking kind of the fractal idea and what that kind of stuff Mandelbrot was doing, you generate price paths from that, and it looks a lot like what markets do. And you're suddenly like, oh, wait a minute, this has to be somehow closer. And so I spent a lot of time trying to figure that out. I never figured anything out really worth using, but because the math didn't play out, but it worked in my mind in terms of thinking about how the market is structured, right?
The
So
path was worth the right.
yeah,
Yeah.
yeah,
The effort.
exactly. So kind of those two things, like it's not a mathematical fractal, but keeping this fractal behavior kind of in mind, along with market psychology, and kind of putting those two things together to come up with ideas for identifying when a market is behaving in a particular way.
And in layman's terms, what you mean by fractals? It's going to jump. There's going to be jump points. It's
Well,
not
no, what
linear.
I think well, there are a couple of things for me that mean like fractals. One is that it doesn't matter what time frame you're looking at, right?
Hmm.
You should see the same type of behavior on a weekly chart as you do on a 30-minute chart, really. And there are limits to that. Like if you go into the really short term, then I think all bets are off there. It's kind of a different arena. But in general, you should be agnostic on time frame. And I used to have this with traders that I work with. Somebody come up and go, oh, look at this 60-minute chart. If you would have bought gold here at this price, look at what the 60-minute chart did. It's like, oh wow, it's amazing. And then they come, 2 weeks later and they'd say, oh, look at this daily chart. Look at this daily chart. If you use this daily chart on this market, you'd have done an amazing. I'm like, well, when do you use the 60-minute? When do you use the daily? How do you choose what time frame you're picking? And what I came to the realization is you can't. There is no way. I don't think there's any way.
Hmm.
So maybe they're all right. So maybe all the time frames are right. Maybe they're all telling you something different in a different level of abstraction within the market, right? So that was kind of the
So,
basis for why we use all the time frames at the same
so
time.
another way to think of that is we can't know which one is right. So we might as well
Right.
participate in all of them. So we're
Yeah.
sure to get
Yeah.
the one that will be right.
Yeah. And I think it came back from, in my finance career, you have this, have you heard the fundamental law of active management and that kind of stuff, which basically you just want to, if you have an edge, you want to bet as many times as you can, like make it
Yeah.
as broad as possible. And that kind of idea made sense to me that if I have a system that works on every time frame, why not bet on all the time frames at the
Hmm.
same time? And if it works in one market, why doesn't it work in all the markets? Why shouldn't I be betting in all the markets at the same time and trying to, really make as many different trades as you can because you think you have an edge, right? And that was the, I guess, underlying basis for 10 dynamics and how we got to where we eventually got to.
I'll real quick, the far end of that logic, right, is that you'll just earn the T-bill, right? That you've removed all the risk and you just get the risk-free, right? If you did that
Well,
across the world in every single market, every single time frame, are you just getting the
yeah,
risk-free rate?
I don't know. It depends on if you can lever that or not, I guess. But
Yeah, true. Yeah.
you get an ever increasing Sharpe ratio, and so and that's what we see in our portfolio. The more markets we add, the more assets we trade, the more the Sharpe ratio goes up. So
Hmm.
it is kind of that I guess implementation of that idea.
So talk to me a second about these time frames. So we're
Mm.
talking, what's the shortest? What's the longest? How
We
many are there?
we we start at a 30-minute time frame, and we go all the way out to weekly, basically. But then we divide the market into lots of different time frames. So we don't stick to necessarily what people would consider the normal time frames or whatever. We just want to make sure we have enough time frames that are different enough. If you divide it too much, then you end up with signals that are exactly the same across a lot of different time frames. So you don't get any diversification there. But we've kind of arrived at like between 12 to 15 time frames, depending on how many hours the market trades, because we do
Yeah.
trade down to intraday.
So it could be
Um,
some like 1.75 days time frame, right? It's like
yeah,
custom. Yeah.
yeah, exactly. And even you can even get different looks. We haven't really done this with some of the things. I think everybody just uses the close for their
Yeah.
daily chart. Well, why not use 12 o'clock? Or why
Yeah.
not use 3 o'clock? Get in before everybody else here. There are some different behaviors around the close, but there's different ways of, if you think about, the difference between kind of precision and accuracy. I'd rather have three different charts that are all slightly different, giving me the same trade, right? But if one out of the three is giving me something different, then that makes me think, is there something weird about just that very special pattern that. So again, to me, it's like having lots of different signals
And then
give
is
you
it
more
like a,
robustness.
is it like a voting machine? So you have seven
Yeah,
say buy, six say sell, I'm long
yep,
one.
yep, exactly. It's
And it's
exactly.
netting out, or are you placing
Yeah.
all 13 trades?
No, no, no. We just net it all out. So we boil everything down to I mean, our process is we have a risk. We basically start at like what volatility are we targeting for the given you know account or fund or whatever. We start with annual volatility. We back that into a daily volatility target, and then we scale the portfolio to try to achieve that target, and that amounts to allocating a risk budget to each asset. So you might say, okay, to hit a 10% vol, depends on how big the account is, but let's say you'd say, okay, well, we want to have at most 100,000 risk when we use VAR. So 100,000 VAR on, say corn futures or whatever. Then we can
Mm.
back that into a number of contracts based on the volatility. And that tells us our max and min contracts. And then what our system does, it just scales between those based on all these different things moving around. So we're always scaling in and out. So we have our 10 signals that we apply to each
Is
time
it,
frame independently.
is it ever
And
flat, or it's always
yes,
scaling at some?
it can be flat, sure,
Got it.
sure, but it'll pass through that. So we tend to scale in increments of 5 to 10%. Um, so we'll take all 10 signals and apply them to a given time frame. That'll give us a position on that time frame, and then we take the positions on all the different time frames and add them up, and that'll give us kind of
Mm.
between minus 100% and plus 100% type of number, and that gives us our scaling for the position. So the model is just constantly sort of scaling in and out based on how the confident, I guess it would be, we call it a confidence measure on the trend.
How better than a confidence game? Confidence
Yeah,
measure. Yeah.
yeah,
Yeah.
exactly. Well,
Um,
trading might be the same thing. We don't know.
how often is it 100%, right? That everyone's voting
Um,
in the same direction across all
I
the
would,
time frames.
yeah, I mean, it happens in really strong trends. Obviously, cocoa's been the darling of the
Yeah.
early part of the year, and orange juice. So there you were, you were running at 100% for weeks at a time. But overall, I'd say it's pretty evenly. It's not quite an. It's definitely not a normal distribution. So it's something like the tails. You're probably 100% long or 100% short, maybe 8 to 10% of the time, something like that, and then kind of up from there. Um, so and it can be flat for significant periods of time too. So it's just depends on how the model is looking at the different trends on the different time frames and how it's all netting out.
And then how many markets? So I thought you
Uh,
were, so it's not
right.
just energy. Energy's your roots and
No,
you're
no. So we do
spread
we
from
do all
energy.
the yeah, we do all the futures and well, all the liquid futures, I guess, in the US. We do European energy futures, we do some financial futures in Europe, we do, treasury bonds and notes, and we do currency futures, equity indices. So pretty much the whole what I guess would be the traditional sort of broad CTA kind of space.
Yeah.
But we also do on the equity side, we do large cap single name equities.
Mm.
So we'll do kind of the big companies in the S&P 500. We also do ETFs.
NVIDIA?
Yeah, do NVIDIA. And the system, what's interesting about the system, and this is probably true of all trend following in the equity space, it's kind of what you'd expect, right? That the more behavioral something is, the better it works. So the big like tech companies and things that are hot, so your high volatility, your large caps that are really moving, system works great. When you get down the small cap space, you're basically talking about beta and earnings announcements, right? So that's like jumps and sort of beta, which is not what you're trying to capture. So the system doesn't really work for smaller cap stocks because the dynamics are different.
No. Um, yeah. See, I know Jerry Parker, Chesapeake's big on single name equities, but the rest
Hmm.
of the trend world has been hesitant to go there for whatever reasons.
Yeah. Yeah, it works well. The hardest part is talking to investors about it because it's not normal,
Yeah, and
right?
they already
So
have that exposure, they think. You're right.
yeah, they think that there's a lot of things that go into it. If you're talking to the big allocators, they have teams. They have a kind of CTA type team or systematic team or quant team. Then they have a market neutral equity team, and then they have a long only team. And then when you say, well, we got a model that trades equities, it can be anywhere from 80% net long to 80% net short. So you've got beta timing in there, which equity guys typically don't
Yeah,
like,
their
right?
head explodes.
Yeah, exactly. So it's a that's been a tougher education hurdle, I think, than we're on the future side, people are much more used to kind of what we're doing. So it's yeah.
So talk about the allocators for a second. Where are they putting you in that trend bucket? Do you guys correlate with the trend indices and whatnot?
We're probably I think we're about between 40 to 45% correlated with trend, something like that. Um, so there's definitely trend exposure there. I think well, it depends on what we do, what markets you include, because if you want to get rid of trend, you can take out some of the markets. I think one of the things that adds to trend a bit is we trade rates. It's a
Yeah.
rates exposure that gives you some pretty significant weight on the trend at the end of the day, but also equity indices as well too.
Do you allow
Um,
investors to do that? Like, I just want the
yep,
commodities.
yeah. So that was one of the things that because we didn't really talk about it, but we just mentioned how we don't optimize. We use the same model for everything. So that means that we're happy to customize to any portfolio. If somebody wants to do a managed account, if they have enough capital to do it, they can customize to whatever exposure they want. So somebody can, and that's what our current managed accounts do. So we will have people say we just want these markets, whatever it is, ags and energy, or we just want we'll take all the futures, or we don't. You can even do just equities if we want to do that. So we're happy and kind of set up to be able to manage to different benchmarks, we call it.
And then on the risk side, you will dig into that for a minute, but do you view it? That's probably where your prop trader roots help the most, right? In my experience, prop traders hate losing even for 10 minutes, right? Versus
Yeah.
systematic guys will be like, no, it's in a 30% drawdown. That was in the back test. It's all fine. So, right, is that part of what you built into the model of like,
Well,
yeah,
yeah, I mean, it's for sure some of it. I mean, one of the things which we kind of talked about is the system scales in and out. So one thing that we don't do is we don't try to make sure that the portfolio is hitting a specific vol target every day, right? Because sometimes you could be in an environment where there's not a lot of trends, and so one of the things that we learned from in
yeah,
the
don't put
prop
on
trading
risk
world.
just for the sake of putting it on. Yeah.
Exactly. And you could see it, it's one of the kind of psychological challenges for being a non-systematic trader is when do you know something and when do you think you know something?
Mm.
And the reality is if you're going to be a fundamental guy, generally big fundamental changes in a market might happen once or twice a year if you're lucky. And if you're a good fundamental trader, you make a lot of money and you tend to outsize your bets when you're confident like that. But then what happens? Well, then what happens is nothing. You think you have an idea and then you get bored. And, there's very few traders who can make one trade a year and then sit on their hands for the rest of the year. And usually what happens is they make a lot of money and then sort of bleed for the next, 6 or 9 months until the next big idea comes along. And so we built the system specifically so it would scale. Like when the model doesn't have a lot of confidence within an asset, it will be close to flat. And when there's a lot of assets that there's not a lot of signal, you'll be close to flat. So, for a 10% annual vol, for us, we in our VAR model terms, it's like a 1.5% daily VAR.
Yeah.
Um, that's kind of our target VAR, but our VAR actually ranges. We could be at 50 bips. So we could be at, less than a third of the target VAR for weeks or even a month. But we can also go as high as 2.5 to 3% VAR. So our VAR range is actually 10x in terms of, we're low deployment versus high deployment. So, and that definitely adds value. So I'm amazed that people can scale up their systems all the time and have it be successful as if they allowed it to sort of reflect some sort of confidence in the signal. And we can do it if we want to, we can force our model to be fully deployed. And what we see is it deteriorates the returns pretty significantly. So that being fully deployed when you have confidence is and not deployed when you don't, I think is a key lesson from the prop side that works in our system for sure.
And it's funny, how do the investors feel about that? I've seen plenty of times where an investor quits a investment, a CTA, because it's flat. And I'll be like, well, its peers are all down 10 to 20%. And
Yeah.
it's like, yeah, but I just want it to be doing something. I want it to be. So I think
Yeah.
it's not just the trader, it's the investor too, who hates seeing just
Or
nothingness.
for sure. And I know for a fact a couple of the big multi-strats, if you go work for a multi-strat, they force you. Like you
Mm.
need to be full, they want you to deploy risk all the time. And if you don't, it's just not the shop for you, right? So there are people like that, and not every shoe fits every foot, right? So that's not our approach. And if usually people like that, they're looking for, I don't know, looking for something different than we are, right? Our whole
Yeah.
thing is we want to deliver the best risk adjusted returns that we can, right? So, and that's without benchmark and without, where other people have correlations that they're worried about, or they want, different things out of their investments.
So talk to that for a minute, since you've kind of been on all sides of this and have some insight into like, do you think you can, doesn't sound like you're trying, but do you think people can recreate a pod shop multi-strat, right, with systematic or quantamental is the new term, right? If you can create
Yeah.
that same kind of look and feel and return profile with models instead of actual traders.
Well, so our experience at Trailstone was that our systematic guys were slightly negatively correlated with our prop guys,
Hmm.
which in a way makes sense because our systematic guys were trend following. And as I mentioned, fundamentals by nature are counter trend. So you got guys doing counter trend trading alongside of trend followers. What does that mean? That means in market extremes, you tend to be flat as an organization, and then you tend to make good money in the middle, usually. So and it's super efficient from a firm level return on risk. So could you replicate? So and I again my experience with systematic is purely on the we
Trend.
are trend following.
Hmm.
I don't, and this is a I think it comes down to your philosophical makeup. I really have a hard time trading counter trend. I can't do it. But people who are quants, they tend to love counter trend. Like it's cheap. Look at the model says it's cheap.
Yeah.
Let's
If you loved it at if you liked it
yeah.
at 40, you'll love it at 20.
Yeah, and that's why, you see a lot of quants doing mean reversion strategies and, pairs and all that kind of stuff. That's really, that kind of mean reverting idea. And that's the problem that I really have with mean reverting strategies. They tend to be negatively tailed, right? So you have
Yeah.
negative tails in the distribution. And again, that goes so against this goes the prop pair thing, not wanting to lose, right? The idea of having a tail event. So our returns are positively skewed, right? And that means that at the end of the day, we probably lose on more trades than we win on, but our winners are, far outsized from our losers. So that's how we, that's by design, right? So,
Yeah. But it sounded when you were talking about building the model, you sounded more like a quantamental, right? Of like, I'm
yeah,
taking everything I know from being a fundamental trader and putting it into the system, which is what this new quantamental is trying to do, right? Of like, hey, now that everything's digitized, we can take all these inputs that used to just be the trader and a bunch of screens and using them, put it into a
yeah.
model and trade off it.
Well, I think the quantamental combination works really good for mean reverting systematic with fundamentals. Because if you think about, if it took me a while to sort of figure this out, but let's say you've got a system that where you lose on 9 trades, but you make a ton on one.
Yeah.
Okay. So you have this sort of very
Classic
low,
trend. Yeah.
yeah, yeah, classic trend. Now you're gonna use a fundamental filter to say, well, I only want to trade when the fundamentals are in my favor because that's going to eliminate all my losers.
Hmm.
The problem is if you eliminate that one winner by accident, you
Yeah.
turn a profitable system into not making anything, right? So it's quite risky to combine a filter with a trend following strategy where you have a few winners because you can easily wipe out the winners, and if you do that, you kill your returns.
Right.
The other way around, if you have a system that wins on 9 trades and only loses once on the 10th, and it's a big loss,
Yeah.
if you're trying to filter that out,
Negative skew, positive skew.
yeah,
Yeah.
if you can filter out the negative skew, that's hugely valuable, right? So,
Mm.
so that kind of combination of mean reverting and fundamentals works pretty good because you're going to filter out those big losers. And if you can do that, that's a good combination, right? Where I think it's a lot tougher if you're in the trend following space to make that combo.
Yeah, which is most trend followers like, hey, we're taking all the losers, but they're small, right?
Yeah,
They know that it's an option profile.
yeah,
We're
yeah,
buying all these straddles, buying, and then boom, it's going to pay
yeah.
off eventually.
Exactly.
So what's next? More markets, more stocks. What do you guys
Yeah,
have
we
on the
just
horizon?
well, we actually interestingly, we just today, I just finished. We had an investor who was interested in the Chinese domestic futures.
Yeah,
And one of the things I really love about our model is how we look at back testing. For us, back testing isn't anything to do with looking back with the markets. It's give us a new market we've never seen and let's see how we do. So
yeah. It's
so we
your
took
perfect out of sample test. Yeah,
it really is, right? So, I just took out of the box, the same model that we use for anything. We loaded up the sort of 30 plus futures contracts, domestic Chinese futures contracts, and ran it. And we get basically the identical Sharpe ratio that we get in the other global futures with less correlation to the trend factor. So it's like, oh, well, this looks all right. So we did the same thing a few years ago on the crypto side. Somebody was interested in crypto, and we said, well, let's have a look, and crypto works fine. So the model seems to be pretty robust to as long as it's a normal market, and we even, one of the things we don't do is we don't cherry pick the portfolio. So, I mean, Coco was a good example. And I don't know if you messed around with any trend following stuff, but I can remember doing some trend following testing, in the 90s. And the one market that stood out as really difficult was Coco.
yeah.
Coco was really not very trendy. And I think it has not been trendy for 30 years. So if you would have not put it in your portfolio, you wouldn't have caught this trend. Now,
Which
if it would
we've
have been,
seen. I've seen that
yeah,
in a lot of
yeah,
portfolios.
exactly. So, if as long as a market is a normal market, just because it's never had a big move doesn't mean it won't. So we tend not to throw things out of the portfolio as long as they don't, behave in a way like are very jumpy. So the model doesn't do good with jumps, right? And no trend following, I think, can really do good with jumps because that's not
So
linear.
like power doesn't work in trend
No,
following.
no, power does. So this is one of the other funny things that we've, given my background, everyone who's a power fundamental analyst is like, oh, trend following can't possibly work in power. And it's like, well, it actually works just fine. Doesn't seem to have a problem. What doesn't work though is like we do some commodity spreads.
Hmm.
So things like Brent TI that sort of move over time, or gold platinum, or things like that that almost behave like a normal market, those are great. What doesn't work is spreads that are tightly linked that then tend to have dislocations. So like certain regional spreads will be very tight. Like there's the wheat spread in Chicago. What is it? The
Yeah,
Minneapolis versus, yeah, yeah,
or KC
yeah.
versus Chicago.
Yeah, exactly. So you wouldn't trade that with trend following, right?
Hmm.
It's kind of a jumpy sort of
Right, because
shock based thing.
it's a nice straight line until it isn't. Yeah.
Yeah, exactly, exactly. So we exclude anything that's too kind of like that doesn't move, or and we also exclude anything that's really too illiquid to follow. But yeah, so we tend to be, we don't want to, I don't like the idea, like when investors will say, well, if we only wanted to trade 20 futures, what would you recommend? I'm like, mm-mm.
Yeah.
You tell me which ones you want to be in, because I can't pick them. I don't know which, I don't know what's going to be Cocoa next year.
Yeah.
But
We did a blog post. We'll put it in the show notes. I think silver it was maybe
mm,
5 years ago. But
mm,
it hadn't made money on a trend trade in 15 years or something,
yeah,
right? It was
yeah,
like 30
yeah,
losers and then had
yeah,
this huge winner. It's like, well,
yeah,
that's what you
yeah,
have this for. To
exactly.
your point, if you try and silver doesn't work, we're leaving that out.
Yeah,
Gold doesn't work.
exactly. And volatility is a bit like that. So we trade the VIX
Mm,
just from the long side, because again, we don't want the negative tails in there. And so we trade VIX and some of the volatility related ETFs, and we do make money with them, but it's not over time. It's not a lot of money, but it really pays in certain times when, trend in particular is getting smashed, right? So it's like
yeah.
the hedge benefit. If you can have a market where you're not steadily losing money, even though it's not trending, that's a great market, right? It just tells you when it does trend, you're gonna make a lot of money in it. So yeah, we tend not to
And then
to try to cherry pick that way.
to that point, do you have this crisis period type profile, or you believe you will in a '08 type
Yeah, yeah,
long drawdown, a 22
yeah,
type drawdown?
yeah. I mean, one of the best years for the model was during COVID. That was a fantastic year for the model, where everything was trending dynamically, and volatility was paying off, and all that. So 2008 would be good as well, because I remember back then you had huge commodity trends, right? Oil went to whatever it was.
Yeah.
Yeah, yeah,
I've gotten in that debate on Twitter and elsewhere. Like people will think about a tail hedge and be like, okay, I'm willing for it to pay 200 basis points a year or whatever for this tail hedge. But then they look at a trend follower and it's only, say it averages 3% a year positive averages. I'm
mm,
like, I don't like that. I'm like, but it's providing that profile with a
mm,
positive carry. If it can hedge with a
yeah,
positive carry, that's the holy
yeah,
grail, right? What are you doing?
yeah. I know. That's
But
what
people
that's
don't
what
get
I,
it.
I know they don't get, like we don't sell, I haven't talked to anybody, but just our volatility portfolio, it'd be a great thing to add. And like I said, it doesn't cost you any money. If things,
Yeah.
go derail again, it'll be there for you. So
And
yeah,
why not do that in the VIX futures versus the ETFs?
we do both.
Okay.
So for people who just want futures, they'll just get obviously the futures exposure. We do the ETFs as well. The other thing that's interesting, I don't know if other people do it, but the triple levered sector ETFs like ERY, which is the energy
Yeah.
triple, that actually acts exactly like the VIX. It decays through time because the trend is because of the costs of being triple levered, plus the fact that it's generally up, right? But then it spikes, and so our system works just as well in triple levered sort of sector products as it does in the VIX, and they tend to spike it. Well, nice thing about energy, it has different spikes, right? So you get these
Yeah.
different
Huh.
chances to capture spikes. So it's kind of an interesting thing that we found.
Anything else we should know?
Um, well, the one thing that I think is interesting, and we mentioned a little bit about if you're trying to capture mispricing. I don't think that what we're doing is capturing mispricing.
Hmm.
Um, if I look at like if you can look at systematics as two types of camps, you have the alpha decay people. And if you're an alpha decay person, if you believe it's constantly decaying, then you're constantly re-optimizing to try to catch whatever's changing to catch that alpha decay, right? And that's your system. So that is to me, that's a mispricing basis. But for us, we're using the same system. And if you look back to the 90s with the same system across the same markets, you don't see any alpha decay at all. What you see is clear cyclical behavior in either look at how you look at whether you look at Sharpe ratios or alpha. We tend to look at Sharpe ratios. So you have years where the Sharpe ratio is really good, and then you have a pattern of years where the Sharpe ratio is not great. And you think about what we kind of dug into it. What's driving that? Well, from a trend following basis, right after 2008, what happened? Well, the economy kind of contracted across the globe. What did that mean? That meant you had oversupply in almost every commodity market, which meant you had downtrending or chopping around messes, right? So trend following during those years on a global basis wasn't working very well because of what was happening from a macro point of view. So there's this tie back to what systematic is catching. It's catching these big investment cycles in energy, let's say. It's also sensitive to these big macro changes. There's times where trend following works well and times where it doesn't. That's not mispricing, right? And people want to argue that it's a factor, but if I look at what people call trend, the return on the trend factor or momentum factor it's not great, right? The Sharpe ratio is not great on that. And what
No.
the good trend followers are delivering is much higher. So I don't know what it is. Is it smart trend? Is it smart? I don't know what it is. I just know that it's not. It doesn't look statistically like mispricing, and we're not chasing alpha decay. So I don't know what it is out there, but there's something to what we're doing that's kind of core to the way markets work.
You rang my bell of what I was going to ask, which ties into what you just said. Do you think it's because of the multiple time frames gives you better monetization, right? Like, are you get Xing cocoa at a better place, for example? Or are you doing things like that because of the multiple time frames and the multiple
For sure.
signals?
The multiple timeframes definitely helps for sure. Um, I think what really happens in our model is the long-term timeframes generate the overall positioning and they generate the overall return. And the short-term timeframes are basically like hedging. They're like smart stops, basically. So they're stopping you out of longer term positions when the short term is turning against you. And so they work kind of collectively together really well.
And the weeks long, so you're using basically weekly bars as we would have called it back in the
Yeah.
90s.
Mm.
Weekly bars. So that trend may hold for 18 months or something. Like what's the
Yeah. Yeah. We look at we look at two different kind of measures of our holding period. If you look at when we adjust our position from say 10% long to 20% long, that typically lasts about 2 weeks. So that's relatively short holding period. But if you look at how long we're net long or net short, that's much longer. That's closer to 2.5, 3 months on average. So if I always use the example of Apple. Apple stock. It was basically an uptrend for how I don't know how many years was that. It was an uptrend for a long time. So the system was never net short Apple for
Mm.
8 years, but it was also flat a few times. So it got to flat and then it got to 100% long and flat. So you kind of have this long position that you're always just sort of delta hedging it based on what the short term is doing. And there seems to be some nice synergy there.
That's another cool way to look at it of delta hedging these long-term positions.
Exactly. Exactly.
Awesome. Well, I think we're going to name the podcast Allergic to Optimization. I like that line.
Cool.
All right.
All right. Yeah,
Well, thanks for being with us. Where
sure.
can they go find out more? Website, all that good
Yeah,
stuff.
we've got our 10dynamics.com. We've got an inquiries tab. You can reach there. We also have a lot of content on there now. We just put out a white paper on how we handle risk management and operational risk from a systematic fund, which is really important. One of the things we've kind of learned by doing, I would say. We
Mm,
hadn't really, and I think a lot of people don't think about it. There might be some interesting stuff there for people to have a
yeah.
look
How do
at.
you
And
view that operational risk in terms of getting your signals off, you mean?
well, just all you can think about if you're trading systematically, and you're really doing it from where you're basically the system's doing everything from selecting the trades to automatic execution and everything else. If you have a problem, there's a lot of ways that can go wrong, right? So what's the best way? What's the best framework to make sure that you're managing that risk, but also that you're not just like stopping the system because one little thing went wrong and then you shut everything down and
Right.
how do you keep from doing 1,000 trades in a day and all this sort of stuff. And I think we came up with a pretty I'm pretty proud of it, I would say, in terms of what we do. And the system really runs well now. And we have a whole framework for how we manage that. So I think
Did you
it's
read the Jim Simons book? I can't remember what it's called. I think I have it right over here. The Man Who Solved the Market. It's about Renaissance and Jim Simons.
oh
That's
yeah. No, I
somewhere in
didn't
there
read.
early on, they were losing money with this model and he couldn't figure it out. And they had basically the sign flipped, I think, for like multiply it by the value of the E-mini, for example, or
Yeah,
something. And they were like, oh, and switch that. And it just started going.
yeah,
So yeah, that's that kind of operational risk. That's
yeah.
more model risk, but
Yeah, yeah. There's all of that plays into it. You've got basically your pure risk management in terms of any limits or metrics that you have. Like we have limits and metrics that we manage, but that goes alongside operational risk. Things like you have a database, and then you need the data from the database to feed into the model. Well, what happens if the database gives a missing value for something? Then what are
yeah.
you going to do? Are you going to shut down the whole fund? Or are you going to just isolate it and can you solve it automatically and all those kinds of things are things that we sort of dealt with over the years. So yeah,
If NA do what? Yeah.
yeah, exactly. Yeah, yeah. We're lucky. We're lucky we are where we are today in terms of technology because I think it's what we've done, we couldn't have done with the time and people that we have. It would have taken so much more 10 years ago than it did today. And just even having Python to do everything in this process, this operational and market risk management process that we have, Python made it conceptually much easier to deal with, I think, than had we been,
Hmm.
you know,
And then
10.
did your team use some AI tools to even write that Python? That's
That's kind of new. Most of what we built, we haven't. We do use it a little bit every once in a while, but it's interesting. It's very good at writing boilerplate.
yeah,
Like, give me a function that does this. Okay. But most of what we do, it gets really confused really
not
easily because
boilerplate.
yeah,
Yeah.
it's not boilerplate. Yeah.
I use it to write some market commentary stuff for some groups and it can't get past. And I even have it in the script. Don't make this error. But right, if the S&P is down 1.5 and the fund is down 1.8,
Yeah.
it'll say that the fund did better than the S&P.
Oh,
I'm like,
really?
yeah, I'm like, no, it was more negative. More negative is not better.
Yeah.
And you even
Yeah.
have it in the script. Don't make this more negative mistake in an
Yeah.
example. And it keeps doing
Yeah.
it.
Yeah. Exactly.
So yeah, it's not quite there, right? So you don't
No,
want that in your trading model to be like, whoops.
no, no. And I guess just philosophically, we're as far away from AI as you can get, given that we don't do any optimization. So
Right.
I don't know if we're dinosaurs and don't know it yet or what, but we're fighting the fight.
Yeah, I have some personal worries about that. That as more people coming into the space have grown up, so to speak, on the AI, they're just gonna unknowingly optimize by using the AI.
Yeah. Well, and it goes even further to, what I mentioned about how the traditional approach to, at least that I've seen with technical trading, was come up with 1,000 different indicators with 1,000 parameters and see what with no connection to the market or what the market's
Yeah.
doing or how the market trades or what's a pattern that makes sense, and this kind of stuff. So
And then the next iteration of that though was okay, all of these don't work. I'm gonna trade the ones that are working now and then rotate, right?
yeah,
Like you keep moving the ones that are working to the
yeah,
top and moving the others to the bottom, and the others can come
yeah.
back in.
Yeah, you have 1,000 AI traders, and then you have one AI trading manager deciding which one of the AI traders to bet on. This is where all this is going to go. But I don't know.
And then you need the AI to write the investor letter every month because no one will know what happened. Yeah.
Yeah, exactly. Exactly.
All right, Bill. Thanks so much. Good talking to
Sure. Thank
you.
you. Yeah, appreciate it.
We'll look you up when we're in London. You gonna go to the Bears game?
Actually, that's not a bad idea. I should
Yeah,
do. I
do
haven't
it.
seen a Bears game since the 90s, but
Yeah, they'll be there at Tottenham Stadium, I believe, against
yeah,
Jacksonville.
yeah. The problem they
Do
always
it.
have here is the football, well, as they call them, the football pitches here, they're not used to such heavy guys. And so the turf is like
Gets destroyed.
every time at Wembley, the guys are like slipping and sliding all over the place because they're just tearing the turf up. So hopefully they sort that for the game. But
Yeah, they're big.
yeah, absolutely.
Awesome. Good talking to you.
All right, you too, Jeff. See you.
Take care.
Yep, thanks. Bye.
Okay, that's it for the pod. Thanks to Bill, thanks to RCM, and thanks to Jeff Berger for producing. We'll likely be off next week. Have yourself a good Labor Day weekend, but back soon after that. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.